Started, please. Got it. Welcome everybody to our monthly market update. Here we are in the month of March, just ending up first quarter. Got some interesting information that we're going to be covering today, talking a little bit about what's going on in the markets, the banking sector, and then what we can do to help offset some of these fixed rate guarantees that we're starting to see. So here are disclosures. I'll leave that up there long enough so that I don't get in trouble. All right, I think we're good. Here's kind of our agenda. What's going on in the markets in 2023 so far. And then we are currently living in what we're calling the golden era of fixed rate accounts. So kind of a fun discussion that we're going to have. There are 4 different types of accounts that we're going to address that we think everyone should at least be aware of. And for a lot of you, I think that there is some good opportunity to start seeing some growth on maybe some assets that haven't seen some growth very much in the last 5 or 10 years. So here's kind of a quick snapshot. We've talked about stuff like this before. I feel like every time I'm in charge of this update, I'm just updating the numbers here, but honestly, the bullet points are staying pretty much the same. So CPI, Consumer Price Index, that's inflation. Starting to calm down a little bit, thankfully. We're starting to see some of what the Fed has done is starting to cool the economy. Now, the big fear is, will it stall the economy? Are we going to be in a full-blown, economic recession? Honestly, at Oxford Wealth Advisors, we believe we're currently in a recession. We might be coming out of it right now. It's still hard to tell. But with layoffs that we've been seeing, with the yield curve inverted, and with 2 negative quarters of GDP production earlier last year, we're calling it a recession. We're there. CPI, Consumer Price Index, has been kind of the leading indicator. That's the biggest thing that most people have been paying attention to for the last maybe 18 months. Starting to calm down a little bit. So CPI for the month of February, we don't have the March numbers just yet. Those will come out in about a week. CPI for February was 6%. That's good, but not great. We're not quite at the point where we need to be, but we're getting there. The Fed is also starting to slow their rate increases. So we saw, what was that, maybe a week ago, Mr. Jerome Powell reached out and increased rates by 0.25%. So right now, floating rate, I think, is sitting between like 4.75 and 5% or something like that. We're getting close to the target. So when all of this stuff was starting originally, when we started seeing inflation be a significant concern, the Fed said 5%. That was the target that they were looking at. So the real question is going to be through the summertime, what happens? Depending on who you talk to, there could be another 0.25 point increase. There are a lot of more aggressive analysts and economists out there that say that they should do one more 0.5% and then leave it. There are a number of very hawkish individuals who are saying that they'll probably start dropping rates pretty quickly here. The thought is they got up to their point, they said that they would get to, and then all of a sudden they're going to drop it again. So things like mortgage rates will start to come down, interest rates in general will start to come down. And assuming that the economy hasn't stalled completely, inflation should probably tick up if that's going to be the case. So the Fed is still between a rock and a hard place to try and get us through this, but so far we're starting to see some of the results of this. So last market update, we talked about layoffs that were happening. Most of the big tech companies had seen some pretty significant layoffs. Amazon is constantly going through and adjusting their workforce. Now we're seeing bank failures. Now, bank failures is kind of an interesting point in a recession. I got to be careful with what I say here, but I don't think that this is too concerning, honestly. This is par for the course with what we expect. Everyone's seeing SVB and Signature Bank failing and thinking, oh my gosh, it's the end of the world. Well, Washington Mutual failed in 2008. Continental Bank failed in 1987. These very, very large banks kind of have a history of doing exactly what they're doing right now. So in our view, this is kind of the tail end of a recession anyways. We'll look at some empirical data with that as well. I'm sure many of you have noticed real estate markets are starting to cool. Labor markets are starting to cool a little bit. You don't see quite as many help wanted signs in the windows of the restaurants. It still feels like there's some need there, but it's starting to cool just a little bit. I think employers are finally right-sizing from some of the adjustments that were made in COVID. And overall, the markets have responded very positively to most of this information that's come out. The big manufacturers, the companies that make up the Dow, have been kind of flat. So they really haven't seen any growth. And that makes sense. There are a lot of banks that are involved in the Dow, so they got beat up pretty bad with all this banking stuff that's going on. But the S&P 500 is up 2.3%. And look at those NASDAQ numbers. Man, we haven't seen that good growth since 2021. Tech has been kind of the safe haven, believe it or not, since the beginning of the year. I was looking at some metrics for quarter 1, assuming that today ends positive. NASDAQ is probably going to be up. Technicals are probably going to be up somewhere in the neighborhood of like 18 to 20%. Now, remember, NASDAQ was down like 35 or 40% through all of last year. So there's a lot of volatility with that index, but it's one of those leading indicators. We start to see that things are, it kind of feels like things are starting to come back a little bit. So let's talk about where we are in the life cycle of banks. I've got up here a couple of graphics. So the first that you can see shows kind of bank failures. And the thing that I really want to point out here, let me change my pen color to red just so that we can kind of see it off of this. The major thing that I want to illustrate here is what had happened in like the late 2000s into the early 2010s. Look at all of those bank failures. Since 2001, there have been 563 bank failures. We've had 2. They've been big. So that's what is illustrated over here. 2 of the 3 of the largest bank failures ever happened this year. And that's a little bit scary. That's kind of taxing on the FDIC. The FDIC has already started adjusting. They're charging banks more for that FDIC sticker in the window. But bank failures is nothing, that's nothing new. This is something that we would expect as a result of a recession. Even lighter recessions like we saw through the dot-coms, we saw bank failures. They weren't as big, but there were probably a dozen, maybe 2 dozen banks that had failed through that period. There were hundreds of banks that failed through 2008. That makes sense because it was a banking crisis. We even expect, I don't want to scare anybody with this, but we expect more banks to fail as a result of what's going on in the economy right now. As interest rates rise, it gets very difficult for banks that are over-levered or not investing in the things that they should be. They'll start to get caught. I can't remember who said it. Lynn or Rich is going to have to correct me on this. It might have been Warren Buffett, but he said, you know who's swimming naked when the tide goes out. That's pretty much what we're seeing with banks right now. So SVB was investing in things that they probably shouldn't have been invested in. Signature Bank, the same. Banks that are doing what they should be doing aren't going to have any issues. Now, I was working in banking. Just a quick side note with this. I was working in banking in 2008, kind of through that crisis. I was with a little credit union, and I can remember we had weekly meetings about the stability and the safety of our deposits and who we were as a company. We were tiny. We didn't manage hardly anything. We were a drop in the bucket compared to some of these bigger guys. But even the smaller banks, the local and regional banks, are taking it on the chin right now. So it's kind of scary. What can we do? What concerns do we face with our banking? It's kind of a scary time, and we've got to be, a little bit cautious. The main concern that we're looking at here is we want to make sure that our deposits are FDIC insured. If we have money deposited with a bank, we shouldn't have too much concern as long as that FDIC sticker is in the window. The people that are really freaking out about this SVB because they had a whole lot more than what they were protected, what they were insured for with the FDIC. Oh, we shouldn't be doing that anyway. So just as a quick side note, the limit on your FDIC coverage is $250,000 per account. I'm going to go and say per bank. If you open up a savings account and a checking account, you don't have $500,000 of coverage. That bank is only covering per Social Security number. So honestly, you shouldn't have that much money sitting in the bank anyway. If you do, then you should probably diversify your risk and move it between 3 or 4 or 5 different banks. Interestingly, one of the richest men that I ever knew growing up, I was like 15 or 16 at the time, and his recommendation has always stuck with me. I said, what can you do to be wealthy? What's one thing that wealthy people do that the rest of us don't? And he said, well, you should never keep more than $100,000 in the bank. Now for 16-year-old Gage, it was like, okay, step one, get $100,000 and put it in the bank. But I think we're meeting with a lot of clients right now who are sitting on some pretty significant cash deposits right now. Maybe it's, tail end of your career, you've got some extra savings, maybe you sold a house or other investment and you're sitting on a pretty hefty chunk of money. Make sure that you're diversifying your risk and not putting all of that just with one bank. That's dangerous. As long as you're under 250, you've got the coverage, but still, don't take the risk. The other thing that they always say is, the FDIC will backstop your deposit, and that is true, but what they don't tell you is that the FDIC doesn't make all of your money immediately liquid to you. What I had read about SVB and with Signature is for all those depositors who were protected under the FDIC limits, FDIC is only releasing maybe $5,000 or $10,000 a week. So if you have $250,000 there, that's going to take you 6 to 12 months before you've got access to all of your money again. Just doesn't make sense. Don't take the risk. Use the FDIC and definitely use banks. I don't think that we should be pulling our money out of banks left and right. But I do think it's time for us to start diversifying our approach, especially if we have sizable balances sitting in bank deposits. That also includes online banks, by the way. I was meeting with a gentleman yesterday. He has like a lot of money sitting in Capital One. And he says, oh no, it's Capital One. They're not just a bank. They do other stuff. We looked at his deposits and he has well more than even $250,000 sitting in a Capital One savings account, only protected up to $250,000. Now, I don't think Capital One is going anywhere, but why take the risk? Why would you expose yourself to that kind of risk? Okay. We'll talk about this here in just another second. I'm gonna show you another resource that we use quite frequently, and actually most of you on the call have probably seen this in the last 6 months. But before we do that, I kind of want to talk about life cycles. So I know that past performance isn't a guarantee of future results. I get that. As a financial advisor, we got to say that all the time. But history tends to repeat itself. Washington Mutual's failure is illustrated here with the X. This was kind of at the peak of all the volatility that we saw in 2008. October of 2008 is when, actually it was late September, when Washington Mutual failed. Largest bank failure ever. That includes even today, and adjusted for inflation, it's sizable, the losses that Washington Mutual saw. But I like to see where this is in the life cycle of where the markets are, where we were in the terms of recession. We started recovering in March of 2009. So about 6 months after Washington Mutual's failure is when the market started to recover. We weren't out of a recession technically until late 2009. So I don't want to say that this is where we stand now, but looking longer term, this is where Washington Mutual failed right at the start of this. The S&P 500 was still negative a year out. The NASDAQ had already seen some levels of growth. Again, I feel like this is repeating. History is repeating itself. We're seeing right now, we're maybe 3 months out from SVB, but things are moving faster because of technology today. I don't know. I kind of feel like we're in that same scenario. We will still see volatility. The markets are still going to be volatile. But for those of you who are starting to say, ooh, I've been sitting on the sidelines waiting for things to improve, it might be a good time to start dollar cost averaging back into the markets. Use good, high quality strategies. If you're concerned about the markets, don't just take everything and dump it all at once. But I feel like we're kind of at the tail end of the volatility that we're seeing. Now, I might have egg on my face. When I do this market update in May, that's the next time that I'm supposed to be doing one of these. I might be saying, whoops, so markets don't look very good. So use the right approach and make sure that you're using as much good data and advice as you can find. To us, it kind of feels like we've turned a corner on some of these things. As the Fed starts to slow down, as inflation starts to calm down, as banks continue to fail, well, that's all kind of what we've seen before. That's what we should start to expect, like we saw in March and April of 2009 to recover. So anyways, there's my take on kind of where the banks are. I want to pause here real quick. Does anybody have any concerns with banks? Are there anything that's keeping you up at night that you're saying like, man, I wish I knew a little bit more about what's going on here, or I feel like there's a lot of hoopla about something, but I'm not really catching up on it. If you do have any questions about that, I would encourage you to reach out to our office. We're more than happy to chat with you about the stability of banks. And honestly, I feel like this is going to be my take here, but banks are always going to be bailed out. Whether we admit it in the moment or admit it a year later, banks are always going to be bailed out because the United States needs a stable place for Americans to deposit money. Banks are that resource for us, so we should be utilizing that as much as possible. And again, the last thing that I do really want to focus on is make sure that you don't have more than $250,000. Strike that, $100,000 in any one bank ever. Diversify your risk and protect yourself. I did just get a question here. What if we have more in other accounts? So that's a good question. When it comes to other types of investments, all we're talking about here are banks. If we have investment accounts, things like brokerage positions or annuities, those have different coverages, different protections that are in place that in many instances far exceed the protections that we have with the bank. So it would be good to sit down and talk with your advisor to make sure that you know what those protections are. But if we've got more money, say in TD Ameritrade or in Midland National or in Equitrust than that $250,000 limit, I still think we're okay because those companies have different protections than what the banks offer. Anytime you see that FDIC, the limit of the coverage that you have is $250,000. Or if you see with a credit union, NCUA, that's the limit of the coverage you should have. And that should really determine how much that you deposit in any one of those positions. Okay, so let's shift over here. Let's keep talking. I got a blank page here, and I'm going to change my color back so I'm not red anymore now that we've got a nice, easy template to talk about. What we want to talk about is this golden era of fixed rate accounts. So what we mean by that, what is a fixed rate account? Sorry for my penmanship here. A fixed rate account is anything that provides a fixed guaranteed level of growth. So the first fixed rate account that we're going to talk about here is called a high yield savings. Now, I know I was just talking about the stability of banks and everything like that, and I'm going to turn around and say, okay, maybe we should be looking at bank deposits. But a high yield savings account right now, they are in their heyday. High yield savings accounts are paying anywhere from 4 to 5%. There are some that are even higher than that. These high yield savings accounts are deposits with banks. So we want to make sure that we don't have no more than 250,000. Oh, no, just kidding. 100,000. We don't want any more there. The cool part about these high yield savings accounts is that they're 100% liquid. Now, for a lot of our clients we've been talking, they say, I've got accounts with Wells Fargo. I've got accounts with Chase. I've got my deposits with Bank of America, and they're not paying very much right now. There's a resource that you can use called bankrate.com. It is free to use. Literally everybody can do it. I'm going to see if I can share screen here with Bankrate. Here is their website. It is a fantastic tool for all things banking. If you're looking for a new credit card, or you're looking for some CD rates, you're looking for home refinance or a home purchase, you're looking for a personal loan or a home equity loan, this can be a great resource where you can kind of just shop the market and see what's out there. Just as a quick side note, I had a client that just moved to Arizona. They just bought a house out in Arizona, and they were saying, ooh, we really don't know what the rates are out there. Well, really cool. We could click on this home purchase price thing, plug in their zip code and see what approximate rates are for other banks in that area, what they would charge. So really a great resource. You don't have to pay for this. You don't have to create an account. That's fantastic. We say just use this as much as you can for your banking needs. What we're going to focus on here, though, is this high yield savings tab. So a little piggy bank. We're going to click on that. As many of you know, the top listings here are paid advertisements. So Capital One's always going to be at the top of this list. It's because Capital One pays to be at the top of this list. They've got a decent rate. 3.4 isn't bad, but you can see as you scroll down, there are some other banks that are offering even higher rates. Basque Bank, for those of you who are in the Texas area, Basque Bank has local branches here. You could walk in and open an account sitting at 4.45. Synchrony Bank, a really, really popular online bank, is paying 4% on their savings account. If we keep scrolling down here just a little bit, you'll see the big three, Wells Fargo, Chase, Bank of America, and then you'll see this tiny little tab that says Show More. If you click Show More, this is where we get all of the high rates. So these are the companies that don't pay to have their name at the top of bank rate, but are just offering the highest rate that exists. We've got a handful of companies that are up at that 5% range. So UFB Direct, CFG Community Bank, both of them have FDIC protected accounts, 5.02%. Now, what's the risk of them failing, Gage? I've never heard of UFB Direct. I've never heard of CFG Community. There is always going to be risk with banks failing. I mean, that's part of investing in banks. They could fail. What's our fail safe? What's our protection? It's the FDIC. So as long as we live by that coverage and make sure that we don't have more than 100,000 in any one of these banks, we think that this could be a very effective tool. If you've got like a $50,000 savings account, an emergency fund that's just sitting there, Wells Fargo earning, what was that rate? 0.15. Maybe we should take a chunk of that out and try one of these banks on for size here. 5%. We've got Salem 5 Direct paying 4.6. We've got Biobank paying 4.5. Bank Purely paying 4.45. Western State Bank, for those of you, I don't know if we've got any clients here in Washington or Oregon, but also a huge bank in your area, 4.4. Banking Direct, Primus Bank. It pays to know. And so using these resources, you can definitely start to see a little bit more bang for your buck, especially for money that you're just parking on the side anyways. So we would definitely recommend using Bankrate and then finding a bank that works. Now, one of the big criticisms of Bankrate is there's nowhere on here that you can click to go to UFB's website. I got like nothing. I'm clicking all over here. There's nothing that will direct me to their site. I actually like that. That means that they're unaffiliated. They don't get paid for clicks going to different banks. You got to go through and find UFB Direct yourself or CFG Community Bank yourself and then open the account directly there. Most of these are going to be online banks. So just a word of warning here for those of you who maybe aren't super tech savvy and you're a little concerned about online banks, these might not be good options for you. However, there are plenty of banks that have local branches. PNC, I think I'm looking at the list here. The majority of our clients here are going to be in the neighborhood of a PNC bank. That is a national bank, very, very large. They've got branches everywhere, and you can get at least 4%. As long as it's got the FDIC sticker, we say it's good. We would say to move forward with it. And we think that these can be very effective tools. Don't overlook your savings accounts. If you're sitting on a sizable balance and you don't plan on using that money, immediately, this can be a very, very good option for you. There are some transfer times and things like that. It might take you 2 or 3 days to be able to access your money, but man, what a fantastic rate we're starting to see with this. Okay, I got to keep things going here. I'm already 20 minutes in. So the next fixed rate account that we want to talk about here is an I-bond. Most of you probably have seen some exposure to I-bonds here. These are government securities, so these are government backed. Right now they're paying 6.9%. Now this is kind of the last push that we have. The rate adjusts again in May. So you have 1 month to get that 6.9%. And spoiler alert, I'm almost positive the rate is going to be lower than 6.9 next May. The way that these things work is you get this rate for 6 months, and then you get the next announced rate for the next 6 months. These are illiquid for 1 year. So don't use like any immediate need money for this stuff. This is longer term. Also, if you decide to cash the thing out between years 2 and 5, there's a 3 month of interest penalty. 3 months isn't the end of the world. We think, honestly, if you pay attention to how the rates are going, more than likely, if you do decide to get out of these things sometime in the next 2 to 5 years, that 3 month interest penalty isn't going to be too great. The other big drawback with these is you can only do $10,000 a year per individual. So it's limited. It's not a huge piece, but hey, again, if you're sitting on $50,000 in the bank and you're saying, I don't really need all of this liquid today, maybe sinking $10,000 into an I-bond wouldn't be a bad idea. It's government backed, so it's about as safe as you can get. 6.9% is a killer rate right now. There are some other rules that apply. If you have questions about these, let us know. We've helped clients open these accounts up. That's the other side of this too, is you have to do this yourself. You got to go to treasurydirect.gov. It's a clunky website. It's not fun to navigate, but man, 6.9%, I can overlook a lot of that stuff. Very, very effective tools we would recommend. The third that we want to talk about here are MYGAs, multi-year guaranteed accounts. Lynn just did a fantastic OWA Live. That's our weekly segment that comes out every Friday. I think last Friday he talked about multi-year guaranteed accounts and fixed annuities as alternatives to CDs. Right now, those 1-year accounts are paying like 4.3%. The 2-year accounts are paying like 5%. And the 3-year accounts are paying like 5.6%. Fantastic rates right now. Now, unlike bank rate and unlike I-bonds, these rates will not change. For whatever period you commit to, that's what you get. Simple and straightforward. You plop money in, you get the guarantee. The other big side of this, something that I really like about these multi-year guaranteed accounts, is they grow tax deferred. So we usually will talk like, yeah, CD rates are pretty comparable to these right now. You could get a CD that's in this neighborhood, but a CD is not tax deferred. A CD will send you a 1099 every year saying, congratulations, you made this much money, now pay taxes on it. A MYGA will not do that. A MYGA will grow tax deferred. You don't have to pay taxes until you decide to take money out of that. It puts you in control of your tax picture rather than the CD. We think that that's a better option. You have to have a financial license to be able to use these things. So anyone who's interested in MYGAs, give us a call. We'd be happy to run through the options, tell you about the companies that operate in this space, how safe and protected they are, and what the rates are. If this is something that you're looking at doing, we think that this is a very, very effective strategy to start getting some guarantees. And the last that we want to talk about, we call cash management. Now, the way I explain cash management is banks are investing in order to get you that 4 to 5% high yield savings account. So like PNC Bank, for example, is taking your money, they're investing in stuff, they're getting a return, they're keeping a little bit for themselves, and then they're giving you the rest. Well, what if we just invested the same way that banks do? Cash management looks at short-term US Treasuries. That's where banks deposit their money. Yes. A short-term US Treasury, these are going to have durations less than 2 years. Because of the nature of these types of short-term investments, they are very liquid. You can buy and sell these things very, very easily. Your rate, we've been seeing rates, they're adjusting. I would say they're 5 to maybe 5.5%. We're seeing on growth right now. High yield savings accounts are getting like right there, comparable step for step. The difference here is because we're investing in those treasuries directly, we don't have to worry too much about the FDIC coverage. So if we're sitting on a lot of money in the banks and we're thinking, I got $1 million sitting in my savings account, good problem to have. And maybe it doesn't apply to most of us on here, but maybe it does to someone. I don't want to have to diversify between 10 different banks and keep track of all of that stuff. Well, a cash management account might be able to get you comparable returns with the safety of US Treasuries. Now, this always sounds funny, and I always get people laughing at me when I say this, but making deposits with the United States government, buying US Treasuries, is the safest thing that you can do. If those fail, we got much bigger problems than what's the performance of my portfolio doing. It turns into, where am I, getting my next meal from? Where's my water coming from? How am I going to generate power? Honestly, that's kind of what we're looking at here. So if we want something that's a little bit more, a little bit larger of a deposit, perhaps this might be a better option for you. Now, all of these fixed rate accounts, I don't expect to be good long-term investments. I don't expect that we're going to hold these things for 10 or 15 years. We're in this golden era right now. We're making hay while the sun shines. The sun is definitely shining on these fixed rate accounts. So if you have any questions or concerns about this, we encourage you to reach out to us. Feel free to give us a call, schedule an appointment. We'd be more than happy to chat about each one of these. We've been talking a lot about this already. And some of you may be saying, Gage, you already told us about this. This is great. Implement then. That's the big key. Take this, apply it to what you're doing in your own finances, and make sure that you're doing the most you can. Okay, that's it. Again, one more plug for our YouTube channel. I think we're sitting at like 149 subscribers, so getting real close to that 150 level. Anyone who's not following us on YouTube, we would definitely encourage that. Just search us, Oxford Wealth Advisors on YouTube. Give us a like and a subscribe. We put out content every Friday, sometimes a couple of times a week. So if you're looking for good financial information, check us out there. Also, we are on Facebook. Feel free to check us out on that as well. And I think we're done. I will take some questions. I see that there have been a couple of chats coming in. Thank you, Lindsay, for putting our YouTube page up there. Anyone who's still on the call, go ahead and click that. Let's go ahead and end the recording, and then I'll stick around